Welcome back. We are talking to David Sykes. He is Chief Investment Officer at TD Asset Management. And you laid out quite beautifully, I might say, in terms of just the landscape, in terms of understanding all the things we have to think about back and forth. So let's kind of ask what it means, though, for investors and your viewpoint right now. You have the Wealth Asset Allocation Committee. You take a look at where the most opportunities lie within what you look at. And the first piece we'll look at is equities. And right now, I understand you're remaining a modest underweight.
Yeah, from the committee's perspective, I think it's fair to say that we're cautious on an economic outlook basis. Yeah. Looking at equities in general, I think it's fair to say modestly underweight. And really the reasons behind that are what we talked about in terms of slowdown of corporate earnings. But just to get a little bit into the details on that, on the Canadian side, we're neutral, a little bit more optimistic there. And I think you've seen the Canadian banks report. The results were okay. I don't think they were stellar. Yeah. I think expense growth a little bit higher there. But if you look at the energy space in Canada and the banks and the financials, some of the dividend yields are very, very attractive. And as we know, over the long run, 20, 30, 40% of your total return comes from that income dividend component.
As long as they stay there.
As long as they stay there. And with those companies, we're very confident. And so, neutral on the Canadian side, a little underweight on the U.S., lots of issues going on. Not so much the debt ceiling concern, but this overarching theme that interest rates, inflation, a little bit stickier, and that is going to bite. It is going to hurt the consumer. It is going to hurt corporate earnings, as we look out the next 6 to 12 months. And on the international side, slightly overweight China, pretty optimistic about the long-term growth there. So from an equity perspective, modestly underweight, a little bit cautious, but that's how it sort of lines up in the sub-asset classes there.
Let's talk about the next asset class, fixed income, maximum overweight.
Yeah, and this is something relatively new for us. I mean, at TD Asset Management, we like our bonds, but we've never been maximum overweight fixed income. And I think that really sends a signal. And the signal is this. In the last 10 years, yields have not been this attractive in the fixed income market. And if you look at, domestic government bonds, yields are 3.5% to 4%. We think that's an attractive place to get income. But in addition to that, if we're correct about the slowdown to come, that really means you're going to get a capital gain on top of that. And so we really do like that government domestic fixed income portion. I think on the corporate credit side, spreads are still pretty tight. We're surprised that they haven't moved a bit wider, so there's not as much value there. So we're modestly sort of neutral in that corporate credit space. And on the high yield side, we've really been surprised. We thought high yield spreads would have shown much more stress than they haven't yet. So there's a modest underweight in that high yield component. But again, I think if we look out 6 to 12 months, I think we feel more confident we can purchase those securities at a much better price 6 to 12 months down the road.
Interesting. Alternatives, you are neutral.
Yeah,
and that's a big basket of diverse stuff, too.
It is. And, alternatives is this huge catch-all phrase. Yeah. But really, it's an alternative to public fixed income and public equity. And so when we talk alternatives, we really think about real estate. And in the Canadian context, people think office towers, that's one component, but it also includes things like industrial complexes, retail, shopping. It also includes multi-unit residential. We're very excited that we're starting to see some green shoots in multi-unit residential. You're really starting to see that come back. And people know all the stories about Canadian housing and the lack of supply and immigration growth. We feel quite strongly there that that's a good place to be. There are some concerns around office. Clearly, vacancy rates are still low, and how does the return to office look? It's started, but, we don't know exactly where that's going to land. Yeah. The other area that we're quite passionate about is our commercial mortgages space. The yields there are very attractive. These are very short duration mortgages, really great outstanding record. And the last one I would highlight that we're overweight is infrastructure. We think the infrastructure needs across North America and across the planet are going to be massive the next 10, 20 years. And so on our infrastructure side, overweight there and quite excited about those returns. Interesting
with the infrastructure, though, I think also just valuation was a concern for some, because a lot of people see that the same way.
Yeah, and I think that's a concern, and people can get very hyped up, but, there's a disciplined approach there to say, look, quality assets, great contracting, diversified, long-term nature, and I think we've got a fantastic team that does a great job there.
I know you do. What else is on your radar? When you just kind of, again, step back, is there anything we haven't talked about that perhaps just some context that's missing?
Yeah, I think there's always, one thing, and I think the trouble is you don't know what that is. We didn't know COVID was coming. You didn't know the debt ceiling would go this far. So there's always that unknown. But I think the one thing that's sort of on my mind more than anything is what does future growth look like? We've got this issue where demographics are real. They're alive and well. And if you look at, the European situation, China's situation, the United States, there's going to be a lot less growth, I think, in the future than we've seen. On the Canadian side, we're quite lucky. Our immigration policy, I think, is really going to help our labor force growth. Yep. And you mentioned it earlier. I'm not sure it's all about AI, but if we can finally get productivity growth, I think that puts us in good stead. But it really leads me back to this notion of still a lot of uncertainty. What you really want to do is make sure you're diversified, you have quality, and you have income. And I think if you have those components in a very broad portfolio, you'll do okay, but I don't think it's going to be, the returns we've seen over the last decade.
Yeah, and it's been tricky too. And as if you alluded to earlier, is that, the discipline of finding things is important because also the breadth in the market has been a bit wonky.
That's a really important point.
Yeah.
If you look at the S&P 500 this year, it's up almost 10%. And so clearly something's going on. The issue, though, is that 99% of that return has been in 6 stocks. And they're the big stocks. And so it's names like Amazon, Apple, NVIDIA, Microsoft, and they're roaring to all-time highs. That's fine, but it gives us concern because you'd like to see some breadth in the market. You'd like to see cyclical stocks, the energy companies, the miners, the financials lead us into the next bull market. And so that lack of breadth gives us some concern.
David, always a pleasure. Thanks so much.
Thanks very much, Kim.
That is David Sykes, Chief Investment Officer at TD Asset Management. Up next, are you thinking about making the transition to self-employment, or do you know somebody who is? Well, if you want to know as you gear up for the next big career start, we're going to talk to somebody who's going to help you to think about what you need to think about right after this.